All right. I have a question, Alan, which is has to do with concentration risk. If I invest through a bond fund, I'm going to end up owning somewhere between 200 and 2,000 securities. If I own bonds directly and I've got $150,000 to invest, I'm going to end up with somewhere between 10 and 20. Am I taking on more concentration risk?
Which I think is a very good question, and we get this question a lot. The response that I have to that is that the number of securities that you have versus if you take the Aussie dollars corporate bond space, which this SMA invests in, doesn't mean that you're going to have a dispersion of issuers that are sufficiently diversified. So there is an Aussie dollar bond fund out in the market, quite a large one, quite a prominent one in the market. It has 57% of its portfolio invested in government securities. Is that diversification? Just because they hold 100, 200 securities in the government space, I wouldn't classify that as being diversified from that space. So what we try and do with the SMA, and I think this is where an investment manager proves his or her worth, or the team's worth, is the ability to basically monitor the market, pick the right securities that are basically providing the highest yield, as well as so that they can deliver on performance, the best performance for the clients, and basically be able to assess which parts of the markets to be invested in on the client's benefits, because that's what we're essentially paid to do. The second thing that I would mention around concentration risks and SMAs and funds is that we really what we're trying to do with the SMA is provide a portfolio of good performing securities that has a high level of capital preservation, as well as defined income streams for the client to meet certain objectives of that particular client. When you're looking at the corporate bond market and you're looking at the investment grade space, and you look at Standard & Poor's statistics, you look at Moody's statistics, in the investment grade space, default ratios, and this is what we're really we should concern ourselves of when you're buying a portfolio of bonds that you're looking from a yield perspective and you're trying to hold to maturity, is something in the 20-year historical default rates at around 0.2%. So when you add on the probability, the management probability aspect around it of a professional manager trying to select those bonds, that 0.15% reduces even further in terms of the potential for that particular investment to lose money.